Let me put this in perspective. On January 20th, silver hit a record high of $95.88 per ounce. Think about that for a second. Just 1 year ago, in January 2025, silver was trading around $31. We're talking about a 207% gain in a single year. This metal has tripled in value, and most people still don't understand why. The mainstream narrative will tell you this is just investor speculation or market volatility. They're missing the entire picture. What's happening right now is the convergence of three massive forces that are creating the perfect storm for silver, and once you understand these forces, you'll see why this is only the beginning. Let's start with the supply crisis because this is where everything begins. The silver market has been in a structural deficit for 5 consecutive years. Let me repeat that. 5 years in a row where global demand has exceeded total supply. We're not talking about small shortfalls here. In 2025 alone, the deficit reached approximately 95 to 117 million ounces, depending on which estimates you look at. That's roughly 10% of total global supply just vanishing into thin air. Here's what makes this even more critical. Unlike gold, about 75% of silver is mined as a byproduct of other metals like copper, zinc, and lead. This means even with silver prices at all-time highs, miners can't just flip a switch and produce more. Their operations are driven by the economics of those base metals, not silver. And starting a new mine from scratch, that takes 8 to 12 years from discovery to production. The supply shortage we're experiencing today can't be fixed quickly, no matter how high prices go. The numbers are staggering when you look at cumulative deficits. Between 2021 and 2025, the global silver market has experienced shortfalls totaling approximately 820 million ounces. That's nearly equivalent to an entire year of global mine production. Where did all that silver go? It's been absorbed by industrial demand and investment, draining down the above-ground stockpiles that the market has relied on for decades. And speaking of stockpiles, this is where things get really interesting. COMEX registered inventories in the United States are down nearly 70% since 2020. The London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. The LBMA situation is particularly alarming. While they report around 760 million ounces in total vault holdings, the vast majority of that backs silver ETFs and other allocated holdings. The real number that matters is the free float, the silver actually available for spot settlement and physical delivery. That number is down to approximately 155 million ounces. At current demand levels, that's enough to cover about 6 weeks of global consumption. 6 weeks. When inventories get this tight, strange things start happening in the market. We've seen silver lease rates, basically the cost to borrow physical silver, spike to unprecedented levels. In October 2025, London silver lease rates exploded to 39%. Let me say that again, 39% just to borrow silver for a short period. Normal lease rates are typically below 1%. When you see rates jump to 8, 10, even 39%, that's not speculation. That's a screaming signal that there isn't enough physical metal available. These elevated lease rates reveal something crucial. There's a growing disconnect between paper silver and physical silver. For decades, the global silver price has been determined by futures trading on exchanges like COMEX in New York and LBMA in London. The paper market, where contracts are traded, has always been much larger than the actual physical market. Some estimates suggest the ratio of paper silver to physical silver reached as high as 356 to 1 at certain points. But here's the problem. When everyone who's been trading paper contracts suddenly wants physical delivery and there isn't enough physical metal to go around, the whole system starts to crack. We're seeing this play out right now. Physical silver in Shanghai has been trading above $80 per ounce, while COMEX futures trade lower. That price divergence shouldn't exist if the market was functioning normally. It's a clear sign that physical scarcity is starting to override paper price discovery. Now let me tell you about the catalyst that's accelerating this crisis exponentially. On January 1st, 2026, China implemented new export restrictions on refined silver that are fundamentally reshaping the global market. And this is huge. China controls between 60 and 70% of the world's refined silver supply. They're not the biggest miner, that's Mexico, but China dominates in refining capacity. The country is home to 27 accredited silver refineries. Japan, which has the second most, only has 13. Under China's new policy, only large state-approved companies can export silver, and only after obtaining special government licenses. To qualify, firms must have annual production capacity of at least 80 tons of silver and credit lines exceeding $30 million. These requirements effectively block hundreds of smaller and mid-sized exporters who have historically served as key suppliers to global industrial users and refineries. China approved only 44 companies to export silver under these new rules. Why is China doing this? Officially, they say it's to protect resources and the environment, but the reality is much more strategic. China has reclassified silver from an ordinary commodity to a strategic material, putting it on par with rare earth elements. They need massive amounts of silver domestically for their booming solar panel industry, electric vehicle production, and electronics manufacturing. By controlling exports, they're ensuring domestic supply, while simultaneously gaining leverage over global markets. The timing couldn't be worse for the rest of the world. Just as demand is exploding, China is turning off the tap. Prior to January 1st, there was a rush of silver exports from China as companies tried to ship metal before the restrictions took effect. In October 2025, China exported record volumes of over 660 tons. But that temporary surge has now ended, and Western markets are facing the reality of significantly reduced Chinese supply. The United States recognized what was happening and added silver to its critical minerals list in November 2025. This wasn't a random decision. The government understands that silver is absolutely essential for the technologies that define modern industrial civilization and national defense. But acknowledging it's critical and actually securing supply are two very different things. This brings us to the second major force driving silver prices, industrial demand. And this is where the story gets really compelling, because we're not just talking about traditional uses. Silver demand is being driven by the massive global transition to renewable energy and advanced technologies. Let's talk solar power first. Each photovoltaic solar panel contains between 15 and 25 grams of silver. That might not sound like much, but when you're installing hundreds of millions of panels globally, it adds up fast. In 2024, the solar industry consumed an estimated 230 million ounces of silver, up fivefold from 2015. By 2030, solar installations could require 250 to 300 million ounces annually. The European Union alone aims to deliver at least 700 gigawatts of solar capacity by 2030. The United States is massively expanding solar infrastructure. China is building solar at a scale that's almost impossible to comprehend. And here's the thing, while engineers are working to reduce the amount of silver needed per panel through a process called thrifting, the sheer volume of panel production is overwhelming any efficiency gains. Solar demand for silver isn't going down anytime soon, it's going up. Electric vehicles are the next massive driver. A traditional internal combustion engine vehicle uses about 15 to 28 grams of silver. A hybrid uses 18 to 34 grams, but a full battery electric vehicle can use 25 to 50 grams or more. Some estimates suggest that with advanced battery technologies, like the silver-carbon composite layers in Samsung's solid-state batteries, we could see up to 1 kilogram of silver per EV battery pack. Global EV production is forecast to grow at a compound annual rate of 13% between 2025 and 2031. Electric vehicles are expected to overtake internal combustion engines as the primary source of automotive silver demand by 2027. By 2031, EVs could account for 59% of automotive silver consumption, and that's not even counting the silver needed for EV charging infrastructure, which also requires substantial amounts of the metal. Then there's the explosion in data centers and artificial intelligence. Silver's superior electrical and thermal conductivity make it essential for the servers and infrastructure powering AI and cloud computing. Global information technology power capacity increased approximately 53 times from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. That's a 5,252% increase. As AI adoption accelerates, demand for data center capacity is projected to grow by 22% over the next decade. AI workloads alone are expected to boost electricity demand by 31%. More data centers mean more servers, more processors, more circuit boards, and all of that requires silver. And unlike gold, which is primarily a monetary asset, silver is indispensable in these applications because of its unique physical properties. You can't easily substitute another metal without significant performance losses. Let me give you the big picture on industrial demand. In 2024, industrial fabrication of silver hit a record high of 680.5 million ounces. That number is projected to surpass 700 million ounces in 2025. Industrial uses now account for well over half of total global silver demand. This is fundamentally different from gold, where jewelry and investment dominate. With silver, industrial consumption is the primary driver, and that demand is largely inelastic. Companies need the metal to manufacture their products. They can't just decide not to buy it if the price goes up, at least not without severely disrupting their operations. The third force at play is investment demand and monetary policy. When central banks cut interest rates, non-yielding assets like silver and gold become more attractive. The Federal Reserve has been cutting rates, and with persistent inflation concerns and geopolitical uncertainty, investors are flooding into precious metals as safe haven assets. Silver ETF holdings surged by 187 million ounces in 2025, an 18% year-over-year increase. That metal, once it enters ETF vaults, becomes effectively unavailable for industrial use or futures delivery, further tightening the available supply. In fact, several major Indian mutual funds, including Tata, Kotak, SBI, and UTI, temporarily suspended new subscriptions in October 2025 due to high physical silver premiums and limited availability of LBMA certified bars. Even large institutional investors are struggling to source physical metal. Retail investors are also buying aggressively. Demand for physical silver coins and bars has remained strong despite, or perhaps because of, the rising prices. People see what's happening in the financial system. They see inflation eroding the value of fiat currency, and they want tangible assets they can hold in their hands. Now, here's where all these forces converge into what analysts are calling the Great Silver Squeeze of 2026. We have structural supply deficits that have been building for 5 years. We have China cutting off a major portion of global refined silver supply. We have exploding industrial demand from solar, EVs, and AI that isn't going away. We have investment demand surging. And we have inventories at critical lows with lease rates signaling extreme physical tightness. What happens when an absolutely essential industrial metal becomes genuinely scarce? Prices have to rise to a level that either destroys demand or brings new supply online. But here's the problem. Destroying demand isn't really an option for most industrial users. Solar panel manufacturers need silver. EV producers need silver. Electronics companies need silver. They don't have good substitutes that won't compromise performance. And as we discussed, bringing new supply online takes years. Bank of America became the first major financial institution to raise its silver forecast, projecting an average price of $56.25 per ounce for 2026, with potential to reach $65. Other analysts are even more bullish. Some forecasts suggest silver could touch $70, $80, or even climb toward $100 per ounce by late 2026 if the supply situation continues to deteriorate. The more aggressive long-term predictions are stunning. Some analysts are talking about $133 to $143 per ounce by 2027 to 2030. There are even forecasts suggesting silver could exceed $200 to $300 per ounce within the next 5 to 10 years if the structural deficit persists and the energy transition accelerates as expected. Now, I'm not here to tell you exactly where silver will be in 6 months or a year. Markets can be volatile, and there will absolutely be corrections and pullbacks along the way. We've already seen that. Silver hit $83.64 in late December 2025, then pulled back to the 70s before rallying again. These swings are normal, especially in a relatively small market like silver that can experience outsized moves in both directions. But what I am telling you is that the fundamental dynamics have changed. The era of cheap, abundant silver is over. The market is being forced to reprice this metal based on physical scarcity, not paper promises. And that repricing is happening in real time. Let's talk about the gold to silver ratio for a minute, because this tells you a lot about where silver could go. Throughout 2025, this ratio fluctuated wildly. At the beginning of the year, it was above 100, meaning it took more than 100 ounces of silver to buy 1 ounce of gold. By the end of the year, that ratio had compressed to below 60, levels not seen in over a decade. Historically, the gold-to-silver ratio has averaged much lower. There have been periods where it was as low as 15 to 20 to 1. The current ratio is still relatively high by historical standards. If silver continues to outperform gold, as it did in 2025 when it gained 143% compared to gold's strong but more modest performance, we could see further ratio compression. If the ratio moved to even 50 to 1 or 40 to 1 with gold at current prices, silver would need to be substantially higher than $95. There's also the question of the inflation-adjusted high. Silver's nominal record in 1980 was $49.45. Adjusted for inflation to today's dollars, that would be approximately $194 to $200 per ounce. Many silver advocates point to this figure and argue that silver needs to reach its inflation-adjusted high to truly reflect its value. We're not there yet, not even close. Here's what keeps me most interested in this story. We're watching a real-time case study in what happens when the paper financial system collides with physical reality. For decades, silver pricing has been dominated by futures contracts and paper trading. But when physical scarcity becomes severe enough, paper prices become irrelevant. What matters is whether you can actually get the metal. We're seeing this disconnect widen. Physical silver in some markets trades at significant premiums to futures prices. Delivery delays are becoming more common. Lease rates are spiking because there isn't enough metal to lend. This is what a market in genuine shortage looks like, and it's fundamentally different from a speculative bubble. A bubble is driven by sentiment and psychology, and it pops when sentiment reverses. A genuine shortage is driven by physical supply and demand fundamentals, and it can only be resolved by either demand destruction or supply increases. Neither of those solutions is easy or quick when you're talking about an industrial metal as critical as silver. Let me address something important. There will be people who say this is all hype, that there's plenty of silver, that prices will crash back down. They'll point to COMEX inventories and say, look, there are still hundreds of millions of ounces there. And technically that's true, but the key question isn't how much metal exists on paper, it's how much is actually available for delivery. A lot of that metal in COMEX warehouses is owned by ETFs, banks, or other entities, and isn't available for spot settlement. The free float, the metal that can actually be delivered against contracts, is far smaller than the total inventory numbers suggest. And as we've seen with the LBMA, when the free float gets critically low, the whole system becomes unstable. There's also the argument that higher prices will bring out recycled silver and stimulate new production. This is true to an extent. Silver recycling provides about 180 to 190 million ounces annually, mostly from industrial scrap and electronics. Higher prices could increase that somewhat, but recycling can't close a deficit of 200 to 230 million ounces per year, especially when industrial demand keeps growing. As for new mine production, we're back to the 8 to 12-year development timeline. Even if companies started aggressively exploring and developing new silver projects today, meaningful new supply wouldn't hit the market until the early to mid-2030s. The market can't wait that long. What does all this mean for you? Whether you're a longtime silver investor, someone who's been watching from the sidelines, or someone just learning about this market, you need to understand that we're in uncharted territory. Silver breaking $95 isn't a peak, it's a milestone in a much larger repricing event. If you own physical silver, you're holding an asset that's becoming genuinely scarce at a time when industrial demand is exploding. That's a powerful combination. If you don't own silver but you've been thinking about it, the fundamentals have never been stronger, though you should expect volatility and only invest what you can afford to hold through price swings. For industrial companies that depend on silver, this is a crisis. Supply chain managers at solar manufacturers, EV producers, electronics companies, they're facing the real possibility of not being able to secure enough metal to maintain production. This could lead to production delays, higher costs, and ultimately higher prices for finished goods. The silver shortage isn't just a metals market story, it's going to ripple through the entire economy. We're also likely to see increasing geopolitical tensions around silver. When China controls 70% of refined silver and the United States needs that metal for solar panels, EV batteries, defense technologies, and electronics that create strategic vulnerability, expect more government involvement, more talk about securing domestic supply chains, and potentially more export restrictions or import incentives. The bottom line is this: Silver has broken $95 because the market is finally recognizing that this metal is in genuine shortage. 5 years of deficits have drained inventories. China's export restrictions are cutting off a major source of global supply. Industrial demand from solar, EVs, and AI is surging and shows no signs of slowing. Investment demand is strong and growing. Lease rates are screaming that there isn't enough physical metal available. This isn't speculation or hype. This is supply and demand economics playing out in real time. When an essential industrial commodity becomes scarce, prices rise until something breaks. Either demand has to fall or supply has to increase, or prices have to go high enough to balance the market at a new equilibrium. Given that industrial demand is largely inelastic and new supply takes years to develop, the path of least resistance is higher prices. How much higher? Nobody knows for certain, but with the fundamentals as tight as they are, with inventories as low as they are, with China restricting exports, and with solar and EV demand accelerating, the risk is clearly to the upside. The meltdown has officially begun. Not a meltdown in prices going down, but a meltdown in the old assumptions about silver abundance and availability. The market is being forced to confront a new reality, one where silver is recognized as the critical, scarce strategic resource that it truly is, and that recognition is going to keep pushing prices higher as long as the supply-demand imbalance persists. This is not financial advice. Everyone needs to do their own research and make their own decisions. But if you've been following silver, if you understand the supply situation, if you see what's happening with industrial demand, then you know we're witnessing something historic. The next 12 to 24 months are going to be absolutely critical for this market. Stay informed, stay focused on the fundamentals, and watch what happens when the paper game collides with physical reality. The silver story is just getting started.